All righty, folks. I've been looking forward to this conversation for 48 hours because I have changed my investing plan for 2025. And frankly, it's a lot because of conversation with Jonathan at Convoy Homes last week. We'll get into that in a minute, but let's welcome Dustin. Dustin, you're back, buddy. I haven't seen you in a minute.
Yeah, it feels good. I miss being able to speak to the community and see both of your wonderful faces on these little tiny boxes we got on this screen Zoom.
Well, folks, if you don't know, he's a dad of two. They are in the back seat. They are feeling a little bit under the weather, but
Yeah,
he is
yeah.
being a good dad and still doing business. So we appreciate you, Jonathan. Let's remind folks of what you and I talked about last week. We talked about investors such as myself who have decent equity. Perhaps last week I was just theorizing if rates went lower and demand fell off a cliff because everybody was scared, that I would go get a portfolio loan across, I don't know, a dozen assets, peel off 7 figures, and then just go shopping. I actually declared today on April 3rd that is the strategy. I am no longer looking to 1031 out of houses into apartments. I look forward to do a portfolio loan, hopefully with a 4 handle on it. And then I'm going to go shopping. So, Jonathan, you actually pushed me this direction. Thank you very much.
Of course, yeah, and it's not uncommon right now, and we're seeing it more and more, obviously, especially as I think people kind of look at the market and looking at the trajectory that it's going. Obviously, in the last, we could talk about it in a little bit. Last 48 hours been kind of crazy, but on average, right? On average, for most individuals, like that drop or that difference is not really going to make that much of a difference in your investing strategy. Always invest in the market that you're in at that moment. So if you're pulling out that cash and you're already putting it into new properties that's going to make a return better than what your rate is even, then that's a positive, good return. And whether it's a single asset cash out that you're doing individually for maybe 10 or 11 different properties, which would be a lot, or a portfolio, right? I think right now, actually, single asset refinances per property are pricing better than actually grouping everything together. So both strategies work, right? It's the same result, just the headache of having to pay more mortgages versus less.
Yeah. The whole idea of what the reason I changed my strategy is, again, I had always assumed that extend and pretend in the commercial sector would not go on forever. But now that we've seen an administration who's clearly bent on lowering rates, lowering the 10-year, which will take mortgage lower, I now envision a chance that this extend and pretend saves a lot of people. It won't save everybody, but it might save more people than I initially expected. Also, the reason I look at doing this kind of equity extraction is I know there will be less competition. The crazy thing about the environment we're going into is it's going to be the best investor market in a long time. We are seeing home buyer demand fall off a cliff. Everybody is scared and getting more scared. What does that mean for a guy like me who's an investor who only looks at the numbers? It's time to go ham. It's time to go find and create those 10, those 12, those 15% yield properties, because some sellers have to sell. And if there's only me, I'm the only buyer, I can almost name my price. So, Dustin, I'm excited by what's coming.
No, I think excited is the perfect word. And, the last 48 hours, and I should really just say almost the last 18 hours have been quite the fun roller coaster that I think we're just starting on.
Just
Because
starting. It's
yeah,
that slow climb. And we're like at the first downdraft of the roller coaster. There's more to come.
100%. And unless you were no offense, living under a rock and not watching what was going on with the financial markets, like the 10-year basically dropped below 4 for about 10 minutes. I'm not saying it's below
Today,
4
it's
right now.
crazy.
Today,
It
right?
did. I saw it. It was crazy.
5 years at 373 or something when I checked 20 minutes ago. And to get an idea, like we say this all the time, but from last week, you can pretty much call your lender, broker, hopefully us. You can expect pretty much a 0.5% rate cut from where we spoke about last week.
That's
And
crazy.
when you have that, it just causes what we tell all of our clients. a reason now that you can see. Let's get in. Let's get this done. You guys have a perfect opportunity. You should love it
Yeah.
now and lock it rather than like it and lock it.
No, yeah. Again, we're in an environment now that the 10-year, again, it got below 4 today for a minute. I'm actually somebody earlier asked me, did I think the 10-year would close below 4 by end of day tomorrow? And I thought about it for a minute and I said, yeah, I think so. I think the 10-year might be under 4. Again, that's just a pure guess. I have no crystal ball, but I'm like, that's certainly where the momentum is. It is to the downside. Jonathan?
Yeah, and I think the main thing that everyone is kind of holding their holding onto their seats for is like, how much lower can it go, right? And I mean, Dustin and I will always tell clients, like, we just sent out a message this morning to our loan officers saying, hey, today, regardless of what happens over the next few days, right? If you have something that's ready to close, ready to go, right? It's not a bad day to just take it off the table,
Yeah,
because
lock it.
just as fast as it went down, we've seen this happen so many times, can go right back up, right?
Mm.
So, if you like it, lock it, secure it, to make sure that you're not gonna, you're not leaving anything on the table, because you're
Yeah.
gonna be punching the air for losing a little bit more than if it were like, if you just went up a little bit, and you don't want to be in
Yeah.
that position.
Well, here's a really strange reality of what's coming. If I'm right about lending demand falling because home buyers basically are sitting on their wallets, I think there's a lot of Wall Street money and a lot of funds that are going to get a lot more creative. And you actually guys have a fund that we talked about 2 weeks ago. You filled it up. They now come back. We're talking about 2 through 4 units, dupes, tries, and quads in the 5s. What the heck is this all about? What do you guys got going on?
Yeah, so now what we can do is, it was so popular, we begged for it, and they basically allowed us. It's up to 70% loan to value, um, purchase, cash out,
Very
or refi.
important, by
Yeah,
the way.
70% loan to
70,
value.
not 60. So like you said,
Yeah,
getting creative. 3 weeks ago, they capped out at 60. We filled them up, and now they're like, all right, let's do 70. That's
yeah,
like that's pretty insane. I mean,
yeah.
go ahead, John.
And then also, it was single family residences previously, only condos. Now it's anything 2 to 4 unit as well. And on top of that, the floor, basically what happened is, at 60% loan to value, you're still going to get the best terms and get to 5.875, 5.75 the easiest. However, if you're in a position where you're at 70% and you want to kind of set it and forget it, for a lot of these clients that are trying to pull out cash and just kind of let it float, this is the opportunity where you can get into a 5 handle, 5.75, not even 5.99, not 5.875, get it down to 5.75, and then lock it in there for a 30-year fix, so that you're not worried about what's happening in the market. You can make your decisions based, it's obviously you buy it down, but you can make your decisions based on what's happening right now
Mm-hmm.
at a 5.75 rate, versus having to wait for the rest of the DSCR market to catch up at the 5.75 mark, right? And I think yesterday I priced something out, um, and someone else was telling me, like, we can get like some other lenders saying that we can get even lower than 5.75 with like 4 point buy down, but I was like, I don't think 4 points really worth it for a lot of loan
Yeah.
amounts. But for the 5.75, when we were looking yesterday, it was only like, I think just less, just a hair less than 2 points to buy it down
Okay.
there. And it was a pretty fair buy down on the current market to be able to secure a 5.75 30-year fix through the whole period, take the cash out at 70% loan to value, which is, again, higher leverage, 10% higher than what it was before,
It's
and then
nuts.
use that liquidity to go out and purchase, new
Yep.
assets.
Yeah. Again, I think what we're going to see in an environment like this is you're going to see more and more funds. I'll call them funds. I'm not sure what else to call them. Get more aggressive, get more creative, frankly, create new products. And it's going to be guys like Convoy Home Loans who kind of brings this to us. There was a time, I call it 6 or 9 months ago, where you guys were bringing us a new program each and every week, which was just awesome.
Yeah.
It shows your, depth of knowledge with your, people supplying the money, but also you're pushing them. You're saying, guys, we need this, we need that. So that's always fun to watch. So I applaud you guys for doing that. Dustin, that's on purpose, right?
Yeah, and look, if you guys had the what is it, the fly in the room and could hear me and John's conversations that we have daily, it isn't just with clients, it isn't just with our employees. A lot of the time it's speaking with the managers or our principals at the funds that we're working with directly and selling our notes to, saying, hey, give us an extra 50 bips here. Hey, give us an extra 5% leverage here. Hey, we've got a bucket of a bunch of clients right now in our pipeline that are at this,
Hmm.
exact 3 buckets. We need some help here. Let's get the pricing down there. Like that's where our true kind of, in my opinion, me and John's biggest value add as running convoy really stands, because there's not, no offense, there aren't loan officers that are employees of mortgage companies doing that type of
Right.
conversation that me and John have.
No, I agree. Convoy Home Loans is a special place. I love you guys being a part of this channel. To that end, Jonathan, I think you were doing some research on FHA. A lot of the doomers are out there talking about delinquency spiking, maybe a foreclosure wave coming. What is truth? What is fact? What is fiction? What's going on with FHA?
Well, obviously, I don't think it's a secret. I think delinquencies are higher across the board, right? We saw it in the commercial space,
Yep.
and then we're starting to see it trickle into the mortgage space. It's always delayed, right? Which is the unfortunate part about all this data. It's always delayed, and then there's always at least what, a 90 days and wait before they file a
Yep.
notice of default.
Yep.
So, a lot of this data that we're looking at now is actually 2024, right? And
Mhm.
I think there's a lot of stuff that came out saying that delinquencies went up. It was like a couple basis points from FHA, and even I saw in some, I went into the rabbit hole, but I saw
Mhm.
in some other areas like Freddie Mac and Fannie Mae loans were also like
Mhm.
delinquencies were higher and defaults were higher.
Yep.
Um, it goes back to your point earlier of this is a distressed market, right? A lot of people are distressed. Some people might have to sell, and what scares us a little bit in our sense is um the market being in a delinquency status in terms of like being higher on the default rates doesn't mean that the world is healthy right now, right?
Mhm.
It doesn't mean that the economy is healthy and that we should almost be celebrating these lower rates. It's a situation where a lot of these people were first time home buyers. They put 3.5% down, and the appreciation wasn't there necessarily, and also they couldn't make the monthly payments because they only put a little amount down, right?
Yeah. Yeah.
And then what we talked about last week is everyone cheers for lower rates, but what they don't realize is lower rates means bad economy, meaning jobs, right? So in the FHA and conventional type space where jobs are the most important part of qualifying for the loan, if they lose that job, right, they're going to be unable to pay. I don't want to say it's going to be as bad as what it was like, what is it now, like 16 years ago, 17
Mm.
years ago. But we're seeing like little glimpses of it that aren't really hitting the news front, right? Nobody's like preaching about it right now, saying that it's
Mhm.
going to end because the market's going to end. The news stations aren't saying it yet, but we are seeing on our side defaults start to pick up, even with DSCR, right? That's not something that's talked about by anybody else, but default rates for DSCR, Airbnb DSCR loans have already defaulted on a heavier rate, right? Last year going into this year. And we're talking about 30-year fixed DSCR default rates going up because again, that's not qualified with personal income. So,
Mhm.
you know, the market is changing, right? Which is what people need to take advantage of it. Advantage of if you're in the market, right, trying to buy something. But the market is changing more so if you try just be aware that DSCR loans, non-QM loans are all kind of risk-based as well. So that risk of, hey, if FHA conventional defaults start to go up, non-QM loans are also going to be a little more wary about issuing out loans. There might be new guidelines that come out to try to protect them
Mhm.
from issuing out loans that are going to go bad, right? So it's just something to keep watch about. Obviously, it's not like raise the alarms, everything's going to end right now, right? Because it's not really that, but it is
No,
kind of
yeah.
like the red flags or beige flags, I guess is what they call it, right? Those are out there right now.
Yeah, the one thing I'll say about FHAs, the other thing that I've investigated, because I follow a lot of people, like Melody Wright does a lot of great research on FHA. It definitely seems like the last year or two, the loan workouts were very much, take the deficit, no payments, stick it on the back, stick it on the back. There's just no equity in all these. These are all foreclosures waiting to happen. So there is no question there's a backlog of low down payment borrowers who won't be able to make payments. So those are foreclosures or maybe short sales that will absolutely need to happen in the next year or two. The question is, will it be enough to change the nation? Will it be enough to change the state? Will it be enough to change the city? That'll all be based on concentration. At the end of the day, folks, as I said, I think at the beginning, I will say here at the end, 2025 is the year of the investor. Is the year that demand falls. It's the year that motivation increases. It is the year that we should be doing great deals. Guys, where should somebody reach out if they wanted to work with Convoy?
Go to convoyhomeloans.com and let us know you came from more at.
Folks,
Right
yes,
there,
there's a
that
little
button.
blue button. Yeah, there's a little blue button. Click the blue button at the bottom of the screen. It says, how'd you hear from us? Put ORAT there. Thanks, guys.
Yeah.